Good evening, ladies and gentlemen, and welcome along to this IC Markets webinar, Forex Indicators, what the charts are telling us. My name is Chloe, I'm with Trade with Precision, and I'll be with you for the next hour or so, going through the markets and having a look at some key Forex indicators. Before we get started, I would just like to give you the opportunity to read this next slide, which is the risk disclaimer slide. So if you could take a couple of moments to have a look at that slide, make sure you agree with everything therein, and then we can get started. Also, take this opportunity to pop into the questions box and let me know that you can see the screen okay, that you can hear my voice okay. That would be fantastic to get that feedback. And also just a little nudge to use that questions box throughout, because I do like to keep these sessions as interactive as possible. So any questions that you have, please direct them to the questions box, and I will hopefully be able to get to as many of those questions as I possibly can in the time that we have. Fantastic, thanks Saida, thanks for the feedback. Okay, so that should be enough time to have read that slide. A little bit of an introduction about myself. For those of you that haven't attended one of these webinars with me before, my name's Chloe. I'm a trader. I've been trading for 12 years now, based in London, and I am predominantly a technical trader. So I use technical analysis predominantly for my trading, and predominantly a trend-based or momentum-based trader. So I trade very much with the flow of the market, and I specialize in trading Forex, commodities, indices, and some other leverage markets as well. So that's a little bit of a background from me, and also by way of a potential apology, I must apologise. Working from home, and I do have a toddler whose bedtime it is, it can sometimes be noisier than other times. We'll see how that goes. Hopefully the sound won't travel too much into the webinar. Okay, so let's have a look at the agenda for today. Now we're going to look at doing a market overview of major currency pairs, and in order to do that we are going to look at some technical indicators. So we'll look at moving averages, we'll look at MACD, and we'll look at Fibonacci, and we will talk about building a watch list or a potential watch list to follow. So without further ado, I'm going to go straight to the IC Markets MT5 platform. So bear with me while I just get that up for you. Okay, so you should be able to see my IC Markets platform. I'm going to start off with, I'll start over here. Start off with dollar CAD here, because that's a relatively clean chart. Now you will notice that I do already have some moving averages on my chart, so I just want to in fact I'll remove those off and we'll start again, because for those of you who are new to the platform, perhaps it might be useful to just know how to add those indicators on. So down here in the navigator window, over on the bottom left hand side, there is a kind of expansion button here, a little plus on the left hand side next to indicators. I'm going to click on that, and that will expand this list of indicators. You can see the options are trend, oscillators, volumes, Bill Williams examples. So I'm going to click the little plus next to trend, and that will give me, if we go down the list, we'll come to moving average. I'm simply going to left click on moving average and drag and drop it onto my chart. That will pop up this box where I can choose what period moving average I'm going to use. So I actually use 4 moving averages on my chart. So the first one I'll put on is the 20 moving average, so period 20 here. I use the exponential moving average. Now, for the purposes that I use moving averages for, it's not actually hugely important whether it's the exponential moving average or the simple moving average. You can choose which one you prefer. I tend to use the exponential moving average. It's weighted slightly more towards the most recent price action, so it reacts slightly more quickly to price, and that's what I prefer. And I put my 20 moving average in blue there. We can select the color down here. So I'm just going to click on OK, and that will put the 20 moving average onto my chart. I'm going to do this 3 more times. So I'm going to drag and drop another moving average, and that's going to be my 10 moving average. So I'm changing the period to 10, and I'm going to change the color to black and click OK. I'm going through this quite quickly because I do believe that most of you probably can do this, and it's hopefully not too tricky. I'm going to put a 50 moving average on there, so I'm changing the period to 50. That one is going to be red. And then finally, dragging and dropping another one. That is going to be my 200 moving average, and I'm going to have that in green. And click OK. So there I have 4 moving averages on my charts. I'll show you while we're putting indicators on the charts, because one of the other indicators we're going to be talking about is MACD. So I'm going to collapse this trend menu over on the left-hand side here, and then I'm going to go into oscillators, which is the next one down, and that's where we can find things like RSI, relative strength index, or MACD, those kinds of things. So I'm again going to just drag and drop the MACD indicator onto my chart. I'm going to use the default settings, which are 12, 26, and 9, and I'm going to click on OK. And I'm just going to collapse that down slightly. So that's the MACD there. Okay, so what I wanted to talk about then, I'll start off with the moving averages. How is it best to use moving averages? Now, with technical indicators, we've got to be a little bit careful, because the majority of indicators used for technical analysis are lagging, because price action has to have happened in order for the indicator to be drawn on the chart. So a moving average, which is the average price of, say, the last 10 bars or the last 20 bars, those 10 bars have to have happened in order for the moving average price to be calculated. So by nature, indicators are lagging, and that's why we want to be very careful about things like moving average crosses. A lot of people talk about trading crosses of moving averages, and the problem with that is that in order for these moving averages to cross, let's use this as an example here. In order for these moving averages to cross, price action already has to have been going up for a considerable period of time. And in fact, when this cross happens, price is already all the way up here. So we've missed all of this move that has dragged the moving averages into the situation where they're crossing. And then actually what happens is shortly after, price pulls back. And so if we were to use the cross as a signal to buy, potentially at this level here, there's limited reward to risk. A question remains as to where you might put your stop loss in any particular trade using a cross, and potential to actually have the market turn around against you for a period of time. That doesn't mean that one should completely ignore crossed moving averages, but what it does mean is that using them as an entry signal can be a little bit misleading, especially in periods of time where the market is not trending, because when the market is not trending, such as in this period of time here, for example, you can see there's a moving average cross there, there's a cross there. The moving averages can cross over each other several times. And if you were to use each one of those as a buy or sell signal, you could get chopped in and chopped out of quite a few trades. So the way that I use moving averages is that I use the moving averages for a couple of things. First of all, to smooth out price action in order to make it easier to see trend. The absolutely most important thing of any technical trader's repertoire is the ability to read price action, because the price action is what all of this is based on. And in order to identify trend, we need to be able to identify highs and lows in price action. So there, for example, we can see here a high, and there's a higher high. Here's a low, and here's a higher low. And so that tells me that this particular currency pair, dollar CAD, on the daily time frame is in an uptrend. The definition of an uptrend is a series of higher highs and higher lows. The definition of a downtrend is the opposite, lower highs and lower lows. Now, for those of you that may struggle to see those highs and lows, the moving averages can help, because the moving averages, if we have fast, medium and slow moving averages on our charts, they can actually, the order that they sit in on the chart can actually help to tell which direction the market is trending, or if indeed the market is trending. So, for example, here currently, where price is trending currently, what we can see is that my 10 moving average, this black one at the top here, is closest to price action, and it's on top. The 20 moving average, this blue one here, is next. The 50 moving average, the red one, is beneath that. And the slowest one, the 200 moving average, is beneath that. So 10, 20, 50, 200 in that order. 10 above, 20 above, 50 above, 200. That indicates that there is an uptrend in place when those moving averages are in order. The other thing that we can look at is which direction are they pointing. In this instance, the moving averages are all pointing upwards, and are the moving averages fanning out? Are they getting gradually further and further apart? Fanning out, that's another thing that can help us to determine how the strength of the trend that we're seeing. So that's one of the ways that I use moving averages. Now we can see over here in this period that actually the market doesn't appear to be trending in terms of price action. I don't see really a series of higher highs and higher lows, nor lower highs and lower lows. And also the moving averages are not in order. So the 10 moving average dips beneath the 20, dips beneath the 50 there. They're all kind of moving in and out of each other. And that is a red flag where we might want to think about pausing trading for the moment until things become a little bit clearer in terms of direction around here. And that's why I say not to completely ignore moving average crosses, because actually what we want to look out for, we want to look out for the moving average cross, not necessarily press buy or sell at that time, but look out for it, because that could be an indication that the trend is about to resume. We need to see further evidence, we need to have further support of that, but it could be an indication that the trend is about to resume, and perhaps an indication that that particular currency pair you're looking at may want to go on your watch list. So just to cover the opposite then, let's find something that is in a downtrend, for example. Something that's in downtrend, let me find something that I've got moving averages on the chart for. So cable, pound against the US dollar. This is something that shows us an example of a downtrend. And so we can see here that the fastest moving average, the 10 moving average, is at the bottom, 20 above that, 50 above that, 200 at the top. So with the fastest moving average at the bottom, that indicates a downtrend. All the moving averages are pointing downwards and they're fanning out. They're getting further and further apart. So that's an indication of a strong downtrend potentially. Of course, in a downtrend in terms of price action, we would be looking for those lower highs and lower lows. Now, that brings me to one of the other important uses of moving averages, and that is as an area of equilibrium. So the definition of a trend is higher highs and higher lows, or lower highs and lower lows. Price never moves in a straight line. It always moves in cycles. The market breathes in and breathes out. So there will be a move in the direction of the trend, and then there will be a pullback, and then there will be a move in the direction of the trend and a pullback. And these pullbacks are part and parcel of the market price action. And what can tend to happen is the market can tend to pull back to an area of equilibrium. By definition, the moving averages, they are an average of price, and therefore price has to return to its average periodically. And so having moving averages on the chart can help us to work out where might be a reasonable place to expect the market to pull back to before the next move in the right direction. Now, as a trader and as a trend trader, it is our job to trade in the direction of the trend, but not only do we want to trade in the direction of the trend, but we want to time it correctly so that we get the best possible price, the best possible entry. So going back to this chart here, this dollar CAD chart, I can see that price is in an uptrend. From this point here, there's my higher high, there's my higher low, and from this point here, my moving averages are in the correct order and all pointing upwards. So there's my higher low. At that point, I want to be thinking about potentially trading long. What I don't want to do is press buy up here, because the market's just going to turn around and probably stop me out of my trade. I'll probably lose money on that trade. What I want to do is I want to wait for that pullback to happen, and then I want to find the best possible price into the trade at a point at which I believe that the next upwards movement of the market is going to happen. So over here, price is moving up and then it's pulling back. And what I want to do, instead of buying at the top here, I want to wait for that pullback and then I want to buy. But how do I know when that pullback is finished? How do I know that price is going to pull back to here and not to here or to here? Well, I can make an educated guess because I've got these moving averages on my charts. And I know from past experience, and markets do tend to repeat themselves, that the market will pull back into these moving averages. And I use the 10 and the 20 moving averages, not as an exact price, but as an area, as a zone that I'm looking out for, where price potentially, if the trend is going to continue, could pull back to before moving off again in the direction of the trend. Now, how do I know that price isn't going to continue downwards? Well, for that, I need to look at the bar by bar price action, the candlesticks. Here we have bearish price action. There's a red candle there. This is actually a reasonably bearish candle because it closes below the middle of the candle there, and then there's a red candle there. Bearish price action leading down to the moving averages. And then follow that with this candle here, which is a very bullish candle, and in fact that is actually a bullish engulfing candle. That indicates to me that the pullback is over, the bulls are back in charge of the market, and potentially this could be the start of the next move up. And so that's the point at which I might want to place an entry long with a stop loss below the low, and then price moves up from there. Let me just check the questions. Questions there about using Fibonacci. Absolutely, yes, we will be looking at Fibonacci as well as another useful tool to work out where a pullback might come to and where the next move in the direction of the trend might start. So these moving averages, let's go back to pound. We can see here that very, very frequently in trend, price pulls back to this area in and around the 10 and 20 moving averages very, very frequently. Over here, over here, over here. And as I said, it's not an exact price, it's not an exact bounce point, but just once price pulls back into this area, in and around the 10 and 20 moving averages, that's when I start to look for my entry point, which will be a candlestick. So I start to look, in this case we're in a downtrend, so I will start to look for a bearish candle in order to indicate that price is going to return potentially to the downtrend. So if I just expand this slightly, so over here, price has pulled back into the moving averages. This area here, in and around the 10 and 20 moving averages, there's a seller bar. I might want to place an entry at the bottom with a stop loss at the top, and away the market goes. To be honest with you, there are plenty of other opportunities here as well. There's another bearish candle there. I probably wouldn't use this one because this one has then moved quite far away from the top of that move. The top is up here, and if I were to use that as an entry beneath there, that's quite a big chunk of the move that I've missed. So I probably wouldn't use that one. But plenty of other bearish candles around here that I could be using for potential entries. Again, this one here, yes, it's a very bearish candle. I wouldn't necessarily use it as an entry. The reason is because it's a very, very large candle. And if I'm using, I mean, in the scope of this webinar, I haven't got time to teach you an entire strategy, but if I'm using a strategy whereby I'm placing an entry at the bottom of a candle with a stop loss at the top, the size of the candle is very, very important in terms of my reward to risk. Because if I have a small entry candle such as this one, price doesn't actually have to move far before I make back my risk. I'm making 1 times profits, 2 times profits, 3 times, 4 times, 5 times. Whereas over here, this huge candle, price has to move a really long way just to get me to 1 times profits, which is much less probable. Jennifer, in answer to your question, Jennifer's asking, is it possible to have a recording of this session? I believe all of these webinars do go up on the IC Markets YouTube channel, so keep an eye out for that. I'm not sure how long it'll take. It might take a day or so to upload, but you should then be able to watch this session back on YouTube. Okay, so in terms of an area of equilibrium, then the moving averages can be very, very useful. And looking out for price returning into this zone in and around the 10 and 20 moving average, and then looking for bearish candles of a small to medium size can be a very useful entry point into a trade with the trend. Now, does that mean that price will always retrace to the 10 or 20 moving average? No, as you can see here, sometimes it goes up to the 50 moving average, but over a period of time, you can back test your strategy and work out what moving averages you want to trade, use as your equilibrium points, what moving averages you want to trade from. I know for myself, trading over the course of the last 12 years, the 10 and 20 moving averages give me the best profits for my my trading style. Okay, so the next thing, which has already been mentioned, would be Fibonacci. So how do we use Fibonacci in order to help us with our trend trading? Before I move on, let me answer Leon's question. Leon's asking, would I enter a trade on the daily or a lower time frame? Really, really good question. So far, I've only been looking at the daily time frames with you. The answer to the question is that a trend trader can trade on any time frame if they have a strategy suited. So The strategy that I use is very, very simple, and actually price action analysis and technical analysis can be very similar across time frames. So you'll notice here, if I now go down to the 4-hourly time frame, bear with me while that catches up. We can see on the 4-hourly time frame, again, price here is trending, lower highs, no lows, and it's very frequently returning to this area in and around the 10 and 20 moving averages. So I can use this strategy on a 4-hourly time frame. Let's go to the 1-hourly time frame where we can see the same thing happening, price moving in trend and pulling back into the 10 and 20 moving averages for potential entries. I can even go down to a 15-minute time frame. And on the 15-minute time frame as well, I can see here price pulling back into that area of the 10 and 20 moving averages. So in answer to your question, where would I enter the trade? I personally do trade a lot on the daily time frame. It suits my time availability a lot because it really is, well, it can be quite quick to trade on the daily time frame. As long as you do your market analysis at the beginning of the week very thoroughly, then really on a day-to-day basis, there's not a huge amount of work to be done. Intraday trading, I do trade on the 4-hourly and the hourly and also the 15-minute time frame. So days where I am at my computer for a couple of hours trading, then that will tend to be on the 15-minute or the hourly time frame. Days where I'm not really trading an awful lot, I will still look at the daily and the 4-hourly time frames. I use the exact same strategy on all the time frames, and I actually use time frame correlation. So I look across time frames and I trade with the major trend on the daily and in fact higher time frames. So I will look at the weekly and monthly trend as well, and I will trade in that direction. So if I'm trading on the daily time frame, I'll be trading in the direction of the weekly trend. If I'm trading on a lower time frame, such as the 15-minute time frame, then at the very least I need a 4-hourly trend. Preferably I will still be trading in the daily trend direction. You can see just from this example that I've picked out here on cable, daily trend here is very much down. Okay, so if I'm intraday trading, I can see just by looking at this trending chart that the moves to the downside tend to be more prolonged and over a greater distance than the moves to the upside. Yes, price does move up. It moves up here. There's a bit of an upwards movement there, a bit more there. So yes, price does move up, but I know over a period of time, if I'm patient, that the best trades, whether that is on a daily time frame or an intraday time frame, are in the direction of the trend. Those are the ones that can run the furthest and I can make the highest profit from, and they have the highest probability of success. The type of moving average I'm using is the exponential moving average. I'm using the 10, 20, 50 and 200 exponential moving averages. So I know that on the 15-minute time frame, if I just move over here, my best trades are going to be the ones in the direction of the daily trend downwards. Yes. Is there money to be made in the upwards direction? Yes, I'm sure there is. You know, here the price is trending upwards. Could you quickly buy and make a profit? Absolutely, yes, you could. But I know from experience that if I'm just patient and wait for the trend to resume in the direction of the daily trend, then I will have greater success and higher reward to risk trades. So great question about the time frames, and thank you for asking that. And the moving averages are the same. I use the 10, 20, 50 and 200 moving averages across all time frames, because again, I'm not using them as exact buy or sell points, and I'm not even using the crossovers as exact entry signals. I'm just using them alongside my price action analysis to help me fine tune my entry point. So the other thing that we can use to fine tune our entry points is Fibonacci. So the Fibonacci tool is up here, the Fibonacci retracement tool. And what we want to do in a downtrend, we want to draw from the most recent high down to the most recent lowest point. So let's just say that we were looking at the chart at this point here. So let's pretend that this point here is the current price action. How would I use Fibonacci? Well, I would go from the most recent high to the lowest point that I have on my chart, which is there. And that would draw my Fibonacci levels in. So the commonly used Fibonacci levels, we've got 23.6, 38.2, 50% is, if the 50 is not actually a Fibonacci number, but it is a very common thing for traders to look for a 50% retracement. And therefore, it's just a useful thing that you can add to the Fibonacci tool, that 50% retracement level, just to keep an eye on it. Then we've got 61.8, 78.6. So with Fibonacci, in a very fast-moving, strongly trending market, price may only retrace to around the 23.6 Fibonacci level. A decently trending market will tend to retrace to somewhere between the 38.2 level and the 61.8 level. Any retracement deeper than 61.8 is considered a very deep retracement, and it can be an indication that the trend may be about to change, or that price may just be about to stop trending for a while. So this area here is the most common area for people to look out for a retracement to. And if that area happens to overlap with something else, such as in this case we've been discussing moving averages. So over here we've got the 38.2 level happens to overlap around about where this 20 moving average is. So that could be a reasonable place to anticipate the end of this next pullback and the beginning of the next move to the downside, which is indeed what happens. Yolina, with regard to price action, I only look at candlesticks. If the question is, do I look at candlesticks or OHLC bars? Yes, I actually do only really look at candlesticks these days. When I first started trading, I did look at OHLC bars. I personally find that the candlestick gives me more information at a glance. I find trading a very visual activity, and really I want to be able to have a glance at a chart and know what that chart is trying to tell me, and I find candlesticks very, very useful for that. I find OHLC bars I have to kind of squint and look at the chart a lot harder in order just to see what's going on, whereas the candlestick, the size of the body, tells me a lot about how strong the buyers and sellers are. The size of the wicks as well tell me a lot about the battle that's going on between the buyers and sellers on each of these individual candles. So both the wicks and the body is very, very important, and I find it much easier to look at on a candlestick than on an OHLC bar. So Fibonacci, we can then look at the next one down. So for example, the most recent high just here down to this low price, and we can see again that that price is pulling back to around the 38.2 level. We can look at from this high down to this low price, and look at this pullback, which has come to the 61.8 level, and all the way down. So we can look at this high down to this low, for example, and again, that pullback is coming to around the 38.2 level. Okay, just catching up on your questions. So yes, Yulina, the candlestick gives me information about the price action. I would say, just trying to answer your question the best way I possibly can. So as I mentioned right at the very beginning, for me, indicators are secondary to price action. So I will always look at the price action first. Any indicator that I'm looking at after that is secondary. So the price action is what tells me what is happening. The price action in terms of trend, higher highs, higher lows. That's the most important thing. Then I will put my indicators on the chart to assist in finding an area that I want to trade in. And my entry signal will be a candlestick, if that makes sense. So let me just get that question back up and check that I'm answering. Yeah, so the candlestick gives me the information I need about price action. So if I'm looking for, I'm looking in a downtrend and I'm looking for the end of a pullback and the beginning of a move to the downside, then I need an area to look at, and that's what I can use my moving averages and my Fibonacci for. That gives me the area to look at. So for example, this one, I think we drew the Fibonacci on. Let's do that again. Let's just do the Fibonacci on here. So that gives me an area to look at between around the 38.2 and the 61.8 area. The moving averages give me that area and suggest that the 61.8 is in confluence with that area. So that might be where I might be looking for that pullback to end. And then I look at the candlestick, because the candlestick is what is telling me the battle between buyers and sellers. In a downtrend, the sellers push the market down, but then if you've sold up here, at some point you're going to want to take profits. So if you sell here, you might want to take profits at some point, and at the point where the sellers decide to take profits, that will potentially result in a pullback as the profit taking is happening. Buyers might also come into the market at that point, and then I need to know, when do the sellers come back into the market and take control, because I want to get back into the next move to the downside. So over here, where I get a seller candle, and it's in this area between the 10 and 20 moving averages, and it's also coinciding with my 61.8 Fibonacci, I've got my seller candle. If I just place an order at the bottom with a stop loss at the top, eventually that will be triggered in somewhere over here maybe, and then the market will continue downwards in the direction of the trend, in the direction of my trade, and I can make profits from that. So price action first, moving averages and Fibonacci next to find an area to look at, and then candlesticks to tell me exactly when those sellers are coming back into the market in order to take price further down in the right direction and make me profits on my trades. Okay, channels. I wasn't planning to cover channels in this particular webinar. I don't personally use channels for my trading because I actually find that the indicators that I do use, the moving average, really I find a moving average enough, because I'm not looking for an exact buy or sell point. I'm just looking for an area, and then I'm using the candlesticks to tell me where my entry point should be. I don't actually need an exact entry point from an indicator. I find channels as well are subjective. Different people draw different channels on the charts, and therefore they're not quite as useful, I find. If you do want to use a channel for your trading, then what you need to do is, in a downtrend, you need to start with the highs. You need to start drawing a channel according to the highs and copy the channel downwards. So you need to join up the highs and then copy the channel downwards. And you can move these lines in and out. In a downtrend, it's the highs that you're using. In an uptrend, you would be using the lows to create that channel. Right now, at this exact moment on cable, your question being which is the most appropriate channel to draw, I mean, price has broken below any channel that could be drawn on this chart. Even if I were to draw this most recent channel here, connecting those highs, price has well long since broken beneath the low of that. If I was to use you know, this one would have to be somewhere around here, and price has long since broken beneath the low of that channel. Even if I were to go onto a weekly or monthly time frame, there isn't really a channel that's particularly useful for me in this case, because we've just had such a strong move to the downside there. Yulina asking, what was the reason that the pound fell down so steeply? It's a really good question. And being in the UK, I can tell you a couple of fundamental things. I'm predominantly a technical trader, but you know, there are times where it's appropriate to keep an eye on fundamentals as well. I guess most of you will probably know we've got a new Prime Minister as of a few weeks ago, and her Chancellor released his first mini budget over the weekend. And it didn't go down well with the markets, and that's one of the reasons that we saw the pound plunge, really drop in value. So we can see here, let's go to the end here. So the pound really dropped in value. This is Friday's trading down here, and Monday's trading. So you can see a gap in the market and quite a spiky candle today. So that is, you know, what people are saying is the predominant driver of the sharp fall in the pound. The pound has been declining anyway. The economy is not good in the UK. We have extremely high inflation. The Bank of England has been raising interest rates in order to try and counteract that, or to try and eventually lower the rate of inflation. We've got very high inflation. We've got a cost of living crisis coming up. The pound is not faring well at all. The mini budget that the Chancellor announced was the straw that broke the camel's back, and that did result in a shock to the market. I don't think it was expected. He cut the top level of income tax. So he's done away with the 45% level of income tax for the highest earners. I don't think that was a particular popular move at all. However, if you look at, for example, the euro, also dropping very steeply. We look at the Kiwi dollar dropping very steeply, Aussie dollar dropping very steeply. You'll see gold has dropped very steeply. So not only are the fundamentals of the British pound pretty bad at the moment, but also it's the dollar strength, the US dollar strength. US dollar is extremely strong at the moment. It has been for quite some time, which is why we're seeing all of these major Forex pairs in such strong trends. We're also seeing at the moment got things like gold, commodities like gold, even the price of oil currently falling as well. And that is predominantly due to this US dollar strength. So in answer to your question, it's twofold. It's partly because of the politics in the UK at the moment, and that mini budget with the drop of the income tax, the fact that the Bank of England are hiking interest rates. In fact, they didn't. There was talk about an emergency interest rate hike, which didn't happen, and I think that shocked the markets even more, pushed them even further down. And then it's the US dollar strength as well in combination. So with that said, we were also going to look at MACD. I'll just have a very brief look at MACD to show you how I use MACD. So you'll remember me saying that the majority of indicators are lagging. MACD is no different. So in order for these MACD lines to be drawn, price action has to already have happened. So MACD is a lagging indicator, but there are ways that we can use it in order to make it more relevant and actually turn it into a leading indicator. So what can happen is MACD can be convergent or divergent with price action. And whether it's convergent or divergent can give us an indication of how strong the trend potentially is. So let me put my MACD on over here. So where drawing trend lines and channels in a downtrend, we would generally use the highs. When we're looking at MACD convergence and divergence, we would generally use the lows in price action. So in a downtrend, we use the lows in price action and the lows of MACD. In an uptrend, over here, we would use the highs in price action and the highs in MACD. Okay, so with that said, let's have a look at that cable. So the MACD here, what I'm looking for, I'm not looking for any lines crossing or anything like that. I'm just looking at the lows in price action and the lows in MACD, and I'm looking at whether those are getting lower together. So here I've got my low in price action, and down here I've got another low. And looking down to the corresponding low in MACD, the MACD is also getting lower. So that means that as price action is trending lower, so the MACD is also trending lower. That indicates convergence. So the MACD is converging with price action, and that gives me more confidence that the momentum behind this trend is strong and the trend is more likely to continue. So we can see that as well here. There's a low in price action, there's a low in the MACD. The MACD is getting lower, the price action is getting lower. That's convergent. It's likely that the trend will continue. Over here as well, lows in price action, lows in MACD, getting lower indicates that the trend is likely to continue. Not indefinitely. We have to keep an eye on MACD, keep an eye on whether it's converging or diverging, and it can just give us an indication as to how strong the trend is, what the strength of the momentum of the trend, and therefore if that trend is likely to continue or whether it's likely to pull back or even pause for a while. It can even give us a heads up to a trend change. Let me see if I can find an example of where it gives a trend change. It's hard because it's been trending downwards for so long. So here, for example, higher highs in price action the MACD is getting lower. That is MACD divergence, and that indicates that this trend here may be running out of steam. The trend, the momentum of the trend is not as strong as it once was, and it could indicate either a change of trend or just a pause in the trend. That's what actually happened here. We just had a period of no trend for a while. It didn't necessarily mean a downtrend was starting. It just meant that there was quite a significant period here of no trend. So going from MACD convergence, where the highs are getting higher and the MACD is getting higher there. And then again, even here, that MACD is higher there and the high is higher. So if we just, excuse my scribbles, but take the equivalent points, you'll notice that price action is getting higher and the MACD is also getting higher, even though the angle is not the same. The angle doesn't have to be the same, but it is just saying MACD is getting higher, price action is getting higher. That is convergence. Whereas over here, the price action highs are still getting higher, but the MACD is now getting lower. So that indicates a potential change of trend or a potential pause or a pullback in the trend. So that's another tool that I find quite useful when I'm trading with the trend is looking at the MACD. I would say in order of importance, price action first, then moving averages and or Fibonacci to give me an area of equilibrium or an area of pullback, candlesticks for that entry, and MACD just as a final check, is the momentum of this trend strong or not. If there is MACD divergence, it doesn't necessarily mean I won't trade. It really depends on the exact strategy that I'm using. It may mean that I might reduce my stake, reduce my risk on a particular trade, or it might mean that I'm less ambitious with a target on a trade, and I might be a little bit more conservative with my trade management. Any further questions on those? Let me just check because I don't want to miss any of your questions. Okay, RSI, good question. And RSI, I do like using RSI. I will use, again, just the default settings. So period 14 RSI. So there it is, the RSI on the chart. Now, again, a lot of people may use RSI to give an overbought or an oversold signal. But again, because RSI, like all the other indicators, is a lagging indicator, price action has to have happened before the RSI line can be drawn on the chart. So by definition, it is lagging, and therefore I don't use it for overbought and oversold. I use it for convergence and divergence again. So very similar to MACD, where I will be looking for convergence. So I will be looking at the highs and the lows. In a downtrend, it's the lows. So for example here, this most recent low in price action and this one down here, the corresponding low in RSI, and where RSI is here, it's getting lower, it's agreeing with the price action. That indicates to me that the momentum of this trend is potentially still strong. If we go back to that little period of time over here, then again, looking at the highs, because this is now an uptrend in price action. So looking at the highs here, here's a high in price action, here's a higher high, RSI, high, higher high. So that is converging, indicating that the momentum of that move is still strong. Over here again, low, low, high, high. So higher highs in RSI, higher highs in price action. And then here again, much the same as with the MACD, the lower highs down there on the RSI, while we're seeing higher highs in price action. That indicates to me that the momentum of this uptrend is coming to an end. The momentum is weakening, and there is the potential that price could now stop trending for a period of time, which is then what happened. So RSI, again, potentially a lagging indicator, but can be used in a leading way by looking for convergence and divergence. Just catching up on the questions here. Let's look at the euro-dollar chart on the daily. Is it not a divergence between July to now? Let me have a look at that for you quickly. Divergence in MACD from July to now. Where is July? So we're looking at the lows. So from this low to this low is convergent. This low to this low, this is the lower one, this is a higher one, and yes, that is divergent because this price action is getting slightly lower, whereas the MACD is getting slightly higher. And you will notice that after that point, there was actually a period of time where the trend was certainly very insecure. Didn't necessarily change trend, but there was a period of time of a few weeks where the trend was no longer there. What's important now is to look at the next highs and lows. So from this is then the low. So the MACD I would take from around this point here, and then it's lower in price action. Does that make sense? So I do see your point that from here to here in price action is a lower low, and here to here in MACD it's actually getting higher, but I would actually delve into that in a little bit more detail because there is actually a low in between there in price action there, and a low in between there in the MACD as well. So I wouldn't miss out any of the lows in order to work out my convergence or divergence. If I wanted to do that, I would go up a time frame and look on the weekly time frame to see is there convergence or divergence in the weekly trend. But I wouldn't miss out any lows on the daily time frame. And in answer to your question, Eleanor, I can give you my name again. My name's Chloe Edwards. It's not going to help in terms of following me because I actually am terrible with social media. I don't actually have or use social media. So, but I do these webinars relatively frequently. I'd love to have you along at another one of these webinars. It would be fantastic to see you again. And of course, you can catch up on the IC Markets YouTube channel as well. So let me take you back to the slideshow briefly, just to give you a little bit of information about IC Markets. They've got a fantastic customer service team, so you can contact them via email, support@icmarkets.com for any questions you might have. They've got a phone number there as well that you can contact them on if you'd prefer to speak to someone. They've got all the usual socials, so Twitter, Instagram, Facebook, the details are there. Find out more about any further webinars we're doing, any questions that you've got, any suggestions of webinars that you would like from us that you perhaps haven't seen so far, please do drop them a line. They'd be more than happy to hear from you, and we'll put something together for you. So it's been a pleasure to be with you for the last hour or so. I hope I will speak to some of you in a webinar in the not too distant future. Have a fantastic evening.